Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say or do should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Saturday, June 15th, 2024, and this is Blockhead Traders Weekly. In this week's episode, it's just myself, Sprocket888, and I'm going to talk about GameStop. What do you mean? And this is a play that I had put on about 2 weeks ago when the volatility and hype really started picking up again. And I'm going to talk you through some of the mechanics and my attempts to profit from the volatility. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what type of content you want to hear about or what you're into trading. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts, so look for us there, like and subscribe, and if you can't find it, let us know and we will get it there. Hopping to this week's content of GameStop, profiting from the volatility. What I want to kind of cover in this is what I consider a safer way, or what's in my risk tolerance of trying to play this GameStop hype and this GameStop mania. So I think you'll notice a particular distinction between my approach here and some of the approaches you might find on many other YouTubers or other things you've read online. I'm going to show you, where you can kind of play this and what the risks are on an upside and a downside, and why I decided to dabble in this. Now, before I kind of hop into that, I want to caveat all of this with this is not a typical volatility selling play that I typically engage in. So usually what I like to do is look for extended volatility that is likely to contract on the short term. So a lot of times this is around earnings. This is around anything that has kind of crept up in volatility really high in the end, and then historically doesn't really stay there. So this is pretty much everything but these meme stocks. And these meme stocks, AMC, BlackBerry, GameStop, all these things you read about on Wall Street Bets, this doesn't fit that. Yes, it has overextended volatility, but this is not something that, typically will revert to the mean. Yes, it will probably sometime revert to the mean, but you really could stay in this extended volatility period for as long as the stock is getting hyped up. And so you have to keep that in mind going into this. And I'll kind of show you what I mean by where that kind of handicaps you, because you don't get that contraction, which you'll see likely means that I'm carrying these things to the day of expiration, because your volatility is not really contracting. In fact, sometimes it's even still expanding based on what's happening in the market. You really can't roll forward for as much profit until you really get to that last day of expiration, and the premium value is really deflating because there's no theta left. Prior to that, it can kind of increase and stuff like that. So we'll hop to that stuff in a little bit later on. And what I want to cover before I start pulling up charts and plays and what I sold and why I sold it is the most important thing that it is to remember is position sizing. So you can't lose sight of what you're actually trading and what it actually represents. And so, in the options world, each contract is representative of 100 shares. So when you sell a put, you are obligating yourself to purchase 100 shares for each contract that you sell at whatever strike price you sell. That's important because that's going to define your maximum downside risk, because the stock could go to zero and you will be out whatever that delta is from your strike price to zero times 100. You'll hear me and see me talk about my max risk here, and I put some asterisk by it because it's not really my max risk. And the reason is because I sold calls that I don't have the shares to back up. So they're naked calls. And really, there is no maximum risk. I mean, theoretically, those can go to infinity, so you can have infinite losses on the up high side. And I'll talk about the strike that I chose and why I chose it, and why I personally don't feel that is as much of a risk as it might be, more to the downside or things like that. So when we get into this, you're going to see that my strike price that I started with on the put side was $35. And I only did one contract because I don't want to consume a large portion of my portfolio in this. Typically, when I trade options on my portfolio, I'm usually targeting between a 1 and 5% position size against my overall portfolio. And particularly with meme stocks, it's not as much of a, let's say, sure thing, or the probability is not as high as some of my typical volatility contraction plays. So I kind of scale that back a little bit to the lower end of that targeted risk tolerance that I have for my portfolio. So everything you're going to see in this video is where I approach this at a simple one contract thing, representing 100 shares at a $35 strike price. So that means that I am basically, if I was in a cash account, I'm putting up $3,500. That's my max loss to the downside. And we'll get into the upside max loss in a little bit when I pull up some charts. But keep that in mind, as basically in a cash secured account, I'm putting forth $3,500 of securing this trade. Now, it happens that this particular trade is so volatile that the broker basically forces you to do a cash secured put. Because GameStop is so memey, so volatile, they don't want to take any risk. And basically, my buying power consumption on this trade is that cash secured put of $3,500. So let's start looking at the numbers. And my trade on volatility started on June 7th. Now, I'll put a link to the previous episode up above where we started talking about this meme stock. Now, this is after Roaring Kitty had kind of surfaced again on Twitter. And this particular trade was more centered around the hype that was he was coming back to YouTube. He was going to say stuff. He had posted things about his position in GameStop. Viper and I covered, all of the myths or kind of misconceptions of what that actually means in that previous episode I linked above. So hop in there to watch that. But this is where the volatility was had already been up for a while, and I was a little maybe late to the party, but that's okay. I kind of wanted to see how it was shaking out, and I said, you know what the heck? I'll go ahead and put a play out there. And I decided that the maximum risk that I wanted to take on this thing, I was okay with the $3,500. And so remember, that represents 100 shares at $35. So I'm basically ponying up $3,500 for this trade. And the first thing I did on that day, because that day volatility was through the roof, and it was a 0 days to expiration, and I wanted to sell a call. Now, the call premiums were very much call skewed, but I wanted to grab a lot of that volatility that was out in time. So that extended volatility went across multiple sessions. And so the first thing I did was I looked at the strike prices that were available at the monthly expiration. So that was June 21st. 2 weeks or 14 days to expiration from when I entered this. And the highest strike available was a 25 Delta $125 call. You could not sell anything higher. They did not have anything on the option chain out there like that. And the fact that the $125 call was a 25 Delta strike when the stock was trading at around $40 is incredible call skew and incredible volatility. I believe it was 4-digit volatility when I sold that, like 1,700%, something of that nature. And this is where the asterisks of max risk is technically looking at this trade, there is an infinite loss above 125. But I was very, very confident that if we were going to breach 125 before June 21st, it wouldn't stay that much above there. And I have the buying power in my account to absorb any of that margin expansion that's going to happen when you get above that. And so I was okay selling that. And the premium for that was $3.95. So almost $400. And that $4 was incredible premium for something that was trading $85 below that strike price. I mean, just insane. And so that was the lowest risk that I could take because 125 was the highest up the chain you could go. And so I sold that at $395. Now, I waited a little bit longer and I said, you know what? There is so much volatility in this and it expires today. Let me go ahead and try to capitalize on the put side as well. So kind of opening up a strangle. Now, it wasn't exactly a strangle. I mean, it kind of is, but I went with the 0 days to expiration on the put side because there wasn't as much put premium because it was just incredibly call skewed. And I wanted to try to capitalize on potential rolls or even assignment and then a bounce and rocket up. And then my calls kind of covered. And so I wasn't really sure what was going to happen, but I was okay selling a put premium. Now, like I said, there was so much call skew, which means all of the premium and volatility was really on the call side for all the speculation and everything. So there wasn't a lot of premium on the put side, but it still was incredibly high for a 0 days to expiration. And so I went with a 35 delta. Like I said, when I made this trade, the stock was trading around $40. So I was $5 below that, $5 out of the money, which isn't that far when we were looking at 20 to 30% moves in GameStop intraday. Either way, I was kind of okay taking that extreme volatility risk and basically being okay with assignment at 35. I just had collected $4 on the call side, and so targeting another $4 on the put side, I collected $380. Throughout the day, the stock price kind of fell a little bit, and I actually was close to the end of the day. I was in the money on the put side. And I thought about, should I take assignment on this? And I decided I didn't really want to take assignment yet because I wanted to see what a roll looked like. Because there was so much volatility, and I'll show you this on a chart, but basically this goes back to the statement at the start of the video that the volatility wasn't going to contract. And so if I could push to almost the end of close to roll the stock, to roll the put, there really wouldn't be any time premium left. And I could basically roll it for just the intrinsic value plus the premium for 1 week out. And that's exactly what I did. It was probably about an hour before close where I decided to roll that share forward just 1 week. And so I had to buy back that stock or buy back that put with almost all of the intrinsic value. Well, it was all the intrinsic value and a little bit of extrinsic, and then sell 1 week out. That roll allowed me to collect almost just as much as I did on selling the first 0 DTE. So I collected another almost $400, $392. So in 1 day, I've collected $1,200 in premium from GameStop on that day of expiration. Now, I kind of held it, and who knows what was going to happen on the following week. That was this week that I'm recording on. And so I kind of held it. And again, there was not this volatility contraction, right? So the stock kind of went down, volatility went up. And so there was really not a lot I could do with that $35 put other than kind of let it sit there. I really wasn't consuming any more buying power. It was still sucking up the $3,500 of that basically cash secured. And I just kind of had to wait it out. Now, it was extremely unlikely, in my opinion, that I was going to be early assigned because there's so much YOLO in this thing. There's so many people kind of maybe hedging their bets. I was fine to hold this again to this expiration of June 14th because remember, I only rolled it 1 week forward. So expiration of the 7th to expiration of the 14th. And again, we finished in the money still. I waited till closer to the end of the day. I think I did it around lunchtime because I kind of had a busy afternoon and I wasn't sure where we might end up. And I wanted to make sure I rolled it because I want to keep milking that premium that's out there. As soon as I got assigned, I'm now sitting with shares. And yes, I could sell covered calls. And yes, I could probably collect some premium on that. But I was more comfortable rolling the put forward, kind of gambling for a pop from the volatility. Because the volatility is so high, we're still looking at a 20% intraday GameStop moves based on the option chain. And sure enough, rolling forward for another $235 was okay by me. And so yesterday, I did roll this forward for another $235. So now I rolled it just 1 week. And so I'm now sitting at a strangle in GameStop on the downside at $35 assignment price or $125 on the call strike. And so what does all of this mean, right? I mean, where is my risk sitting? So because I've collected about $1,400 with the last roll, I am now sitting at a cost basis where I can shave off $14 from my max risk or my assignment price. So you can look at that as I've collected $1,400. That's in my pocket. and I can take that off of that max risk of $3,500. And you can see that now I am essentially long 100 shares of GameStop at $2,100, or a cost basis of about $21 so far. And why I'm calling that out as so far is because the volatility is still elevated. The volatility has not yet come back down and contracted to the point where it's no longer really profitable for me to keep rolling this stuff. And so I intend to keep holding these puts and keep rolling them kind of week by week, milking that premium. Now, the reason I'm not going out far is because the volatility is so volatile, that if I roll forward beyond a week, the volatility might skyrocket and I'll miss out on that, on selling that very increased volatility, because it will have locked in the short volatility prior to that. And so at this point, I am really just kind of rolling this thing until the volatility dries up, and then I'm going to pack my bags and go home. And I'm hoping that by the time I do that, the total premium that I have collected will have outweighed where this stock ends up sitting when volatility finally goes back to a normal level. So let's just try to take a look at this graphically on a chart. So what I've charted out here is a couple things. So we got two red boxes. These red boxes are basically when I started this trade on June 7th. The end of the red box is the expiration of the current options that I'm holding, which is June 21st. Both the put and the call expire on June 21st. This dotted orange line is my current cost basis of $21. And so you can see I do have assignment risk because I am trading in the money for that put. However, I am above my cost basis. So that means even if I was assigned, I could quickly sell those shares away and remain profitable on the overall trade if this is where it sits. I also, if I got assigned, I could quickly turn around and sell an at the money call, which, by the way, has incredible call skew even now. And so that's a zero risk trade, because when it's a covered call, you have the shares to cover it. So I can collect that premium. And if the thing skyrockets, yes, I might miss out on some potential upside, but I'm going to go ahead and keep the premium I collected. I'll end up selling the shares for the strike price, and all of that stuff will be green, green, green. And so that's really where we're sitting down here. Yes, there is this high side, but let's take a look at this 125. Now, when you talk with meme stocks, there's no telling how high this can go, because it's really crazy. But if we just take this chart and we zoom way out and we just take a look at that 125 strike, I mean, really, yes, we spiked up here back in 21 to 120, but I mean, we were there momentarily for that intraday then. And really, taking a back look, this is the last time that GameStop really went as hyped up as it was. And you can see historically, okay, yeah, maybe we'll touch it. Maybe as a very, very black swan remote chance, but the likelihood of staying elevated up there, in my opinion, is essentially zero. It's not really zero, but it's so low that I'm willing, and I have the account and the buying power to absorb any of the margin expansion should I go up there. That's very, very, very important to understand, because even if you think, oh, it's never going to be up there, and maybe you over leverage yourself and you're like 125, I can get $400 for these calls. Maybe you sell 10, 20, 30. You're going to collect a huge premium. But if you get up there and your account doesn't have the buying power to hold that margin expansion, your broker will liquidate you. He doesn't care. And so you have to be cognizant of what that is actually representing, so you don't get yourself into a position where you can't handle that drawdown. And then if I look at the rest of the stuff and keep my dotted line, okay, it's a meme stop. Yeah, recently we traded a lot below that. Okay, that's where I'm talking about my max loss, where I'm okay going to zero. I have to be that way to enter this trade. Is the probability it's going to go to zero? I don't believe that for a minute, but it's possible, and I have to be okay with that. You can see the majority of this time we traded above a $21 strike. One of the other pieces that's kind of playing into my thesis here, or my comfort of this trade, is one of the things GameStop has been doing is they've been issuing new shares. So GameStop isn't a really healthy company, and I don't want to endorse GameStop as going to be around forever. I think they have an archaic business model. I don't know how they're going to make money. Maybe they come up with something innovative. I don't know, and I don't really care. But the key point here is that one of the things that really detracts on companies are earnings and debt and stuff like that. And the ability for them to sell shares at these elevated prices and issue new shares to the market, help them pay down their debt, help them, reduce some of that exposure, which naturally makes them a healthier company. And so, is this an investment? Absolutely not. Would never touch this thing. But it seems to be hitting the meme stocks, and the likelihood of hitting some weird meme craze that pumps this thing up to $70, $50, in my opinion, is out there. And so that's where this risk reward comes into my calculation, that my downside risk, by collecting all this premium, I am mitigating that downside risk. And, I'm exposing myself to the upside potential. Should I be assigned, I'm basically long those 100 shares. And if nothing happens, okay, I'll take my premium and go home, and I still come out a winner. And so that's where my head is at, kind of going into this. And I went back and forth on, do I touch this? Do I not touch this? It's so, people losing all kinds of money. And when it comes down to it is, you can control the risk that you're exposed to, and understanding the mechanics of how this works can help you expose yourself to the type of risk that you are comfortable taking, which is what I did in this particular event. So the last thing I want to touch on and talk about here is this notion of this volatility doesn't necessarily contract quickly. So this goes back to the fact that typically the plays that I look for are for extended volatility. We're in the upper IV percentile ranges, maybe coming up on an earnings, maybe coming up on an announcement of some kind where that volatility is going to quickly deflate, and I'm going to profit on that short-term elevated volatility. In this particular case, there's nothing that is in the immediate near term that's going to dry up this volatility that you can see. And so that's where this trade differs a little bit. And you can see on this chart that I have pulled up over here, down here on the red and green chart is the volatility chart of GameStop. And you can see that historically, there's not a lot of times where it gets green with a cliff. There's a tiny little cliff here around earnings. And you can see right here is where Roaring Kitty returned back to Twitter, and volatility started really ramping up and creeping up. We're in a 92% IV percentile right now today. When I entered some of these things, we were closer almost to 100% volatility. Or at least historical volatility. But look, we're not seeing a predictable contraction. We're in what I would consider a permanent elevated state. It's not really permanent. It's just you don't know. There's no upcoming event that's going to drop the volatility out. And that's why I'm only going week to week, because there could be something that drives volatility up higher, and I don't want to miss out on shorting that new volatility. And I also don't know when it's going to end, and so I want to be here for as long as I can. And that's why I'm going week to week. How long will I keep doing this? Until that volatility dries up. So as soon as that volatility starts falling off back down to where it has been historically, I will probably stop rolling. And at that point, I will either be out of the money and I'll be able to close out my positions at no cost whatsoever. They'll expire worthless. Or I'll be in the money and I will get assigned shares, and I will quickly sell a call to get out of it. I will sell the call at the money or something to that effect. But I will have collected all the premium along the way, lowering that cost basis of my trade. That brings me to the end of this week's episode. The real takeaway here is, at least in my opinion, that you can trade these meme stocks. You can trade risky stocks. You can do so in a manner that can lower that risk and mitigate that risk. It never will take it to zero, because there is a correlation between the risk you take on and the reward you can receive. And that balance of that risk reward is really where you have to figure out what you're comfortable with. There are other traders in Blockhead Traders that were straight up buying calls on GameStop. That's not fitting my risk tolerance personally. So the risk there is you pay for this premium of the call and you're looking for that quick price appreciation. Theta is decaying. Maybe the stock price is falling. And so you stand to lose everything that you paid for that call. Now, if that goes in your favor, you stand to make way more money than my trade here. And that is the risk reward balance that you have to take into. I don't follow the markets every single minute of the day. I typically like a little bit more passive. This isn't really passive 100%, but it's what I'm comfortable with on my risk and reward ratio. And the only reason I can tell you that that's my comfort level is because I understand the mechanics of under that. And I know that for my position sizing, one contract is the maximum that I want to trade on this for this risk and reward ratio. And a lot of people will look at some of the buying power consumption when they sell options or even buy them for that matter. Although buying, you don't really deal with margin expansion, you do that on the selling side, and they will over leverage themselves. Now, that's super dangerous because on paper, it looks like you only have to pony up so many dollars to sell those puts. But should those work against you, you will have massive margin expansion potentially that could far exceed your account size. And understanding what you're representing there and being okay and thinking through that max loss scenario before you enter is incredibly important. That you have mentally agreed on your plan and understand what can happen worst case scenario and you're okay with it. If you look at it and you go through the worst case scenario and you're like, oh man, I don't want that, don't enter the trade. Even if you're like, well, I don't want that, but that's never going to happen. That's where you can get yourself into trouble. Sure, maybe 90% of the time it works out fine for you, but it's that 10% of the time where it might work against you. And that, depending on how much over leverage and stuff you put yourself into, can wipe your portfolio out or can put a significant dent and set you back in your wealth creation goals. And so understanding the mechanics, understanding what it is that you're trading and what does that represent from a standpoint of impact to your capital, impact to the buying power consumption and max risk and exposure you have is critical. Because if you don't understand that, then you can't understand the risk to reward ratio because you don't understand your max risk. So your ratio won't work out, and that's where you can get yourself into trouble. And this is just an example of the thought process that I go through for my risk ratio decisions. That doesn't mean that my risk ratio is the same as your risk ratio. You might view this and say, oh my gosh, Sprocket, I can't take that. That's way too risky. I don't even want a chance of that. This isn't for you then, find what your balance is. Or maybe you look at that and say, geez, you're leaving too much money on the table. I'd go ahead and pony up more risk. That means you have a higher risk tolerance than me. Go for it. Trading is all about finding your comfort and what you are okay with so that you can sleep at night and not worry or stress or things like that. And the best way to really be able to do that is to be able to quantify that risk and understand what it truly is so that you can balance that against your own tolerance. And hopefully that is something that you have identified yourself or that you are on the way of identifying where you fit in your risk tolerance and what your risk reward ratio actually is. And you find trades that support it. Good luck out there. And remember, think outside the block.